His latest columns called Bad News for Bonds is terrible news for stocks this day. It's time for markets to grow up.
We don't want to grow up. Please, we want our thumb back in.
We need our fix.
Yes, exactly.
Are they going to come to the rescue, though?
No, I don't.
Central banks, is this it?
I don't think it's it because, in essence, if the stock markets really do scream and shout and throw their toys properly out the pram, then we will find the central banks will have to change their tune. I just think it's interesting. We've got a little bit of tapering, possibly from the Bank of Japan, though I actually think they are very firm on their yield curve control. The ECB has definitely been tapering, and there's talk about, therefore, when does the next, the first rate hike come for them? That'll be 2019, I'm sure. But the Bank of England yesterday, I mean, I'm not sure how political it was, but it was unfortunate timing at a number of different levels, taking the politics away from it. You know, this is not the right time to all of a sudden volte face on your rate thing, because they really told us in November that it was essentially one and done and 2 rate hikes over the next 3 years. That's like never in money market terms. So all of a sudden now, sooner and more of them. That's quite a noticeable change. Right after 2 days of the biggest volatility we've had for literally for months or not years. So equally, the Federal Reserve, I mean, they have been conspicuous by their absence. So the central banks aren't here for us anymore. That's not necessarily what perhaps investors really wanted to hear this week.
So if this really is a tantrum, Marcus, on the way to growing up, how long does it take?
Longer than this week. And I think the close this week of stock markets and the fact, more importantly, if you look at a 30-year yield chart on US Treasuries, it shows you they haven't backed away. January has been all about yield gains, and despite a brief blip on Monday and perhaps Tuesday, straight back at it, rising yields. That is caused because of inflation, because of increased US Treasury issuance, because of the tax reforms, because of an overall influence that is subtly changing, is that the growth and strength of the economy is finally feeding through, as it ought to find inflation. That means higher bond yields, it means higher corporate borrowing costs, it means leverage plays are more risky, it means a rebalancing of risk. Oil coming down at the same time. China perhaps being less supporting of its markets after some pretty poor trade data. Combine the whole lot, and really we got a longer shakeout than just this short fix, which maybe triggered it, might signify. This is a bigger shakeout.